2018. Mr. Samario, do you want to start off, or is
Yes.
Ms. Tomaszewski going to
No,
make the
I'll
presentation?
start.
Okay.
Thank you, Mr. Chair, members of the committee. My name is Bob Samario. I'm the Finance Director. So to give you some context for why we're here, in the old days, we used to come to the Finance Committee every quarter. We're now doing it twice a year, mid-year, end of the year, to give you a report on how we did or are doing in terms of our revenues and expenditures relative to budget. It's just a kind of a status report. Clearly, now that we're at the end of the year and we're closing the books, we can give you much more final numbers, how the year ended, not what we think it's going to do and all that. The numbers aren't completely, they're not 100% audited. We are going to have the auditors come out soon, and so they are subject to some change. We don't expect they're going to change much. But because of that, we kind of qualify these numbers saying that they're preliminary. We will be coming back to you in December when the CAFR is completed, and we do this every year, as you know. We have our auditors come out and talk about their process, and we give you the final numbers. And at that point, we also share with you final reserve calculations. How did we end the year relative to reserves? We have a sense of it now, but there are a lot of moving parts that could change those reserves between now and December, so I don't want to give you a number until we got that wrapped up. So today we're going to give you our preliminary review and report on how we think we ended the year for fiscal year 2018. As usual, we'll start off with the revenues in the general fund, and then expenditures, and then we'll move on to enterprise funds. We also have attached to the report the budget adjustments, and we will go through just a few of those, not all of those, or we're going to go through them pretty quickly. And then we're going to make a similar report to council, so you'll end up having to hear it twice. I do want to introduce Jennifer Tomaszewski, who you know as our accounting manager. She's now our finance and treasury manager, so I want to congratulate her. And she was very bold to decide to go ahead and take this on and do the actual report for both revenues and expenditures. She's new to it, so she asked me to ask you to be patient. And then I also want to just note, you all know that Mark Sewell is now our accounting manager. He'll be starting on October 1. We're excited to have him start. And I appreciate the sacrifice that Parks and Recreation is making in that regard. So with that, I'll turn it over to Ms. Tomaszewski.
Thank you, Mr. Samario. Ms. Tomaszewski?
Thank you. As Mr. Samario stated, I will be going through the presentation today. As part of that presentation, I will be going through the general fund revenues, the general fund expenditures, the enterprise funds, and the highlights of the proposed budget adjustments. So first, we will look at the general fund revenues. And this first slide, this shows the budget to actual comparison in our, Oh, I didn't even notice that. So this shows our taxes, other revenues, and fees and charges. And the main takeaway on this slide is that what we're looking at here is a surplus of about 1.1 million at year end in our revenues, and we will go through these in more detail on the next few slides. But I did want to put some context to this, in that 1.1 million is not taking into consideration the anticipated year-end variance. When we take that into consideration, it actually becomes a $1.2 million deficit. And just to refresh your memory, that anticipated year-end variance is a budgeting tool that we use to account for potential expenditure savings that we're budgeting into our annual budget. So this next slide is a little bit more detail on the tax revenues. So in total, we see that tax revenues ended the year about $750,000 below budget. Now I'll go through a few of the highlights on this. So when we get to sales tax, we see sales tax ended the year about 1.4 million below budget. When we developed the fiscal year 18 budget, in that budget was built in about a 1.5% growth estimate. We know that there's been a closure of a major retail store. We've had vacancies in the downtown area. Just the overall trend away from brick and mortar stores to online sales. And then we also have the impacts of the Thomas Fire that account for this. What we see in that, in the estimate of the 1.5% for the budget, what actually happened is about a 2.5% decline compared to last year. So that's where we see this 4% swing. One other item that we wanted to point out that's included in this number, in January, the state, they took away some of the responsibilities of the Board of Equalization and created a new agency, the California Department of Tax and Fee Administration. And we were recently notified that there was a glitch in their system. And with that glitch, what that equates to is about $200,000 that we should have collected that we didn't collect. We've estimated that number, and we don't know when exactly we're going to be getting it, but that is included in this 1.4 million because we didn't know enough about it and when we're going to receive it to accrue it. So that is included in here as well. Next, Measure C. So as you're aware, Measure C went into effect April 1st this year. We budgeted about $5.5 million, and what we see is about a $4.3 million or about $4.3 million so far, which results in about a $1.2 million deficit. We believe about $500,000 of this, about $500,000 of this, is related to that general downward trend in sales tax. The other $700,000 is a little bit more unclear. We believe that it may be just the fact that it takes time for vendors to implement their local vendors to implement that additional 1% in their collections in their accounting systems. So as those vendors file their tax returns and the state processes those for compliance or non-compliance, they will pursue that additional 1%. And over time, that number will gradually collect additional that would technically be fiscal year 18 revenues as well. Again, we just don't know how much and when that's going to happen. So on to property taxes. We actually see property taxes have gone up about $2.3 million. And when the fiscal year 18 budget was developed, there was an assumption of about a 5.5% growth in the budget. And what we see, and the number here is 10.5%, but about 8.5% of that is due to those increases in assessed property values. So we budgeted 5.5%. It's coming in about 8.5%. We also have one property that was previously in the redevelopment agency that was sold that accounts for that other 2%. So it was a one-time amount. The last item I wanted to point out on this slide is the TOT revenue. So this is a combination of a couple things. So hotel revenues are on a steady increase of about 1.6%. However, those are, I don't know what that is. Okay. That's offset by the decision to curtail the short-term vacation rentals. So the combination of the two is this deficit that we see here. So again, in total, taxes ended the year about $750,000 below budgeted levels.
Councilmember Dominguez.
Just a follow-up question on these revenues. So the property tax, that 10.5%, that's the variance. That's not the actual increase year to year.
That is the change from last year to this year. It is an increase.
So are the actual, this 34 million, that's 10% more than it was last year, or?
Correct.
Okay. And if you look back at the previous years, are we seeing, you said the estimate was about a 5% growth?
Yeah, I think the last couple years it was tracking between 4 or 5%. I don't have, maybe we do have those numbers.
So has it been an abnormally high increase the last year, or maybe abnormal is not the right accounting term, higher than the previous year?
So, Mr. Chair, Committee Member Dominguez, I'll give you just the last few years. The growth in FY15 was 4.3%. In FY16, it was 6.1%. And then in 17, 7.6%. And we just, relatively conservatively budget about 5.5%, have been budgeting 5.5% growth per year.
And so FY18 is 10.5%?
Yeah, and the real growth is about 8.5%, as Mr. Tomaszewski indicated. About 2% of that one-time revenue from the sale of the RDA property, which we got a piece of those proceeds.
Okay. And then, thank you for that. And then the TOT, I didn't understand your, what did you say about the short-term rental revenue?
Basically, we're not collecting for much of the short-term vacation rentals anymore. So that's part of the deficit. It's offset by the increases in the hotel collections.
So the lack of revenue was more than we anticipated in terms of the short-term rental?
Correct.
We're still collecting it in the zones where there's legal, lawful short-term rentals? Okay.
Yes.
Thank you.
Okay, so the next section is other revenues, and this is comprised of business licenses, fines and forfeitures, franchise fees, and so on. In total, we see that there's actually a surplus at year end of about 2.1%. And I just wanted to highlight the main driver there. This $3 million is almost entirely fire mutual aid revenue, and we budget very conservatively on mutual aid activities because that can shift so greatly from year to year. But we did have a high fire year this year. We will also see this on the expenditure side, the impacts to the fire expenditure budgets as well. And then we also have a budget adjustment regarding this at the end. The last item I wanted to point out is miscellaneous. We're also going to be looking at this on another slide. And there's one more thing I just wanted to point out. It's not a large dollar amount impact, but we did collect about $160,000 in unbudgeted cannabis application fees. And so that's where you see the actuals so much higher than where it was compared to last year. So that's it for other revenues. General fund fees and service charges. This is broken out by departments, and I really just wanted to highlight a couple of these. So community development actually ended the year about $172,000 over budgeted levels. This is just due to a moderate increase in general permit activity, whereas on the public works in the public works department we see a deficit of about $420,000. This is relating to engineering services or the engineering division. The engineers in this division charge out to capital projects, and there were several vacancies. We also see some salary savings that offset these reductions in revenues as well. So in total, fees and charges ended the year slightly below budget by a little less than $300,000. On this last slide, we have miscellaneous revenues, and I did want to highlight a change from last year. Last year, we see that this was about $4.2 million compared to $1.4 in miscellaneous revenues, and the main driver here was the $2.5 million that was received from Plains All American for the settlement for the Refugio oil spill. And really, the only other item I wanted to point out is the operating transfers in. So we see these ended the year about $775,000 below budget. These are mainly transfers in from other departments for budgeted loan reimbursements. One of the bigger ones being the Excella project. There was enough revenues generated by the departments that they didn't need the loans. Therefore, they didn't need to reimburse to the general fund. So that's what we're seeing here. So that's it for the general fund revenues, and this next slide will go much quicker. So this is the general fund expenditures. We see general fund expenditures ended the year with about a $3 million savings compared to budget. And really the only one I wanted to point out is for fire. This is listed by department. We see that fire was actually over by about $2.4 million. So as I was explaining in the revenue side, the mutual aid activity, this is the offset to that. This is the increased overtime costs for firefighters for mutual aid activity. There were also some minimum staffing and some unbudgeted vacation cash outs in here, but the vast majority of this is related to mutual aid. So the main takeaway here with the general fund revenues and expenditures, it's like, well, what does that mean? So we've added a couple slides in here that I'm going to hand it back over to Mr. Samario to go through what the impacts to the general fund look like at this point.
Okay, so at the risk of complicating things, I'm going to go back to one of the original slides to give you some kind of perspective on how revenues did. So you could see that before we factor in the anticipated year-end variance, it shows a surplus of $1.1 million between budget and actual. That number is artificially, or I should say inflated, by the fact that that includes mutual aid revenues of $3 million in that number. Most of that, or a good portion of that, is offset by increased costs. But that number is really skewing this year-end result. If we were not to have any mutual aid revenues at all, that number would be a negative $2 million number, and that's something to keep in mind. Even though you're really going to be seeing on a subsequent schedule that the very bottom line number 1.1, because we do treat the year-end variance as a revenue, even though it represents what we expect in budget to see in expenditure savings. So the 1.1 is a little misleading in that it includes sort of one-time mutual aid revenues. It doesn't kind of speak to the economics of what we're seeing. It's essentially we're seeing taxes being not performing well for a number of reasons, and some other revenues not doing well, but really the taxes is the big deal. But property taxes is an exception to that, and it's helping to offset a lot of those decreases we're seeing in bed taxes and sales taxes. So it's really, saved the day for us, and we're hoping to see continued growth in property taxes. What we don't know is what's happening with sales tax and bed tax in the future. Sales tax is a much bigger issue, with the economic forces. Bed tax is more of a local issue, and we'll have to see how the tourists respond to what happened in December, January, and to what extent they're going to be returning back, and where we see the kind of growth we would expect on a given year of 4% instead of 3 or 2% or a decline. So I want to just kind of give you that context before I get into the other stuff. So this is, This is kind of a recap. If you kind of try to combine revenues and expenditures from a budgetary perspective and our preliminary year results, it's confusing because it's a two-dimensional approach. But essentially, when we talk about, okay, how do we, when all the dust settles, we have a budget, we know what we thought we were going to do, but at the end of the day, how did the year end? In just looking at revenues minus expenditures, and you can see on a preliminary basis, we ended the year with a deficit of $2.6 million. And I'm going to qualify that number in a moment. But and that doesn't factor in encumbrances and the like. But essentially, expenditures exceeded revenues by $2.6 million. That theoretically, on a normal basis, and I'll explain why it's not the case here, but on a normal basis, that's what would impact our reserve balances. That would fall to reserves. Our reserves in total would be lowered by that amount. So as we looked into the details of this, what we find is that this $2.6 million on an actual basis is driven by the fact that we did have a deficit. As Ms. Tomaszewski indicated, we had a deficit on our Measure C revenues in that we only brought in 4.3 or so, but we budgeted 5.5 and in fact transferred $5.5 million to our Measure C capital fund. One approach would have been to say, well, since we're short 1.2 in revenues, then we should short how much we're transferring to the Measure C Capital Fund. The problem is we've already budgeted those monies. We've started the projects. It's primarily streets. So it's hard to undo that money. So what we'll do is in this year, 19, we're going to have to make adjustments to what's budgeted in 19 to lower it to repay the general fund for the $1.2 million shortfall we got on the revenue side. Does that make sense? So even though the 2.6 reflects that, we know we're going to essentially get that back by transferring that much less in 19 than what we get. We're going to have to make that up. So the general fund will be restored by that $1.2 million. So it's not a true use of reserves. It's just sort of a timing thing. So we're not disrupting projects that have already been contracted and started underway. So that brings us to kind of a year-end variance of more real number of $1.4 million. But then as we look more closely, we find that our policy, as you know, says that any year-end surplus, half goes to reserves, half goes to capital. In 2017, when we really wanted to make sure we had fully funded reserves, we decided that when we had fully funded reserves, we had excess reserves of 1.4 that we said, let's just send it all to capital. We don't need any 50% to fall down to reserves. We're fully funded. We're good. So the 1.4 was an excess that we had and said, send it all to capital. Well, we didn't do that until 18. So the surplus was 17. We closed the books and we didn't get a final number until 18. So we transferred that money out in 18 from reserves, but it's from not policy reserves, but from surplus reserves. It just shows the use of reserves here. It doesn't talk about what pocket it came from, but just to be clear that the 1.4 is really coming from surplus reserves, not policy reserves. So at the end of the day, and that's true of the 188, there was $188,000 that we budgeted from reserves this year, but it came from designated reserves for our police station fuel tank project that ran over, but it came from designated reserves. So in reality, we didn't use any policy reserves at all as a result of the 2018 year-end results. We ended up really, in terms of the impact of policy reserves, with a surplus of $179,000. So we will be adding to our reserves the policy reserves of $179 when all is said and done, because of the way this has been funded and these transfers have been funded. What that means for what our status of reserves are, I don't know, because as you know, the one part of the calculation we have to make in determining what our reserve requirements are is what's the next year's budget looking like. And as you know, every year generally it grows, and so our reserve requirements grow. For every $4 million of budgetary growth, we have a $1 million additional requirement for our policy reserves. That's 25%. And we've talked about that in the past, that we generally need about $1 million of surplus each year just to stay even with our reserve requirements. So I know we're going to end up adding 179. I just don't know what that growth is. Is it $1 million? Is it less? I know there are some things that could help add to our reserves that as part of our year-end adjustments and reconciliations. One, for example, is we have these MLAP, Employee Mortgage Loan Assistance Program loans that are still outstanding. We still have a few $1 million left on those. To the extent those get repaid or refinanced or fully paid off, those become available reserves, because even though they're part of our assets, we don't count those as being available because they're long-term loans. So things like that could help. Essentially we are going to need $1 million more to maintain policy reserve status, fully funded status. I just can't tell you where we're going to be, but I'll be able to tell you that in December once we close the books and have them audited and do our reserve calculations with these moving parts that affect that number. And then a couple other things just to mention. Ms. Tomaszewski indicated that that error in the transition from State Board of Equalization to Department of Tax and Fee Administration, they had a glitch in their system, so we were shorted in sales tax revenues, the 1% base that we have. We expected that we would have gotten it by now, and if miraculously we get it between now and September 30, we would be able to accrue it as a prior year revenue, but our policies say that unless we receive that money by September 30, we can't accrue it to the prior year. It's money we will get. It's an estimate, but it's money we will get. It's likely this year, 19, but not sure, not exactly guaranteed, but something to think about that's going to help us for 19. And then we did have some mutual aid costs in the police department. This is kind of a new thing for us. You typically see that in fire, but we had an agreement with the county for reimbursement of costs that we incurred at the police department responding to those emergencies. And we are expecting to get $400,000 back to us again, because we aren't expecting them by September 30. We can't accrue them as prior year revenue, but they are going to come in 19 as revenue, unbudgeted revenue. So just wanted to give you a full picture of kind of how we ended the year. If you just look at the bottom line number, it suggests that we have a $2.6 million deficit, and which we do, and that we're going to consume that much in reserves. But when you look at the details, you'll see that it's most of that is going to fund our capital fund from prior surpluses. And then the Measure C is really the big deficit, another big deficit that we're going to get reimbursed in a sense from that next year. Unfortunately, just means less revenue for Measure C projects. That's the downside, of course, but in terms of balancing our general fund, we will get that back. Any questions on any of that? I know that's a lot to kind of take in.
Councilmember Dominguez.
Thank you. So the amended budget number in slide 14, the 2.869 deficit, I'm comparing that to the 2.622. So trying to make some good news or optimism out of this. So the actual deficit is a little bit lower than we expected after we amended the budget. Is that fair to say or no?
So you're comparing the 2.6 million, if you look up at the screen, the 2.6 to which number?
To in slide 14, under the amended budget, we were anticipating a 2.8.
One more.
The left-hand column on the bottom.
So, as I said, when you start looking at this two-dimensionally, it gets a little more complicated. What this slide here is to undo the impacts of Measure C, the deficit created by Measure C, and undo the fact that we transferred money above policy surplus to the capital fund. So if you just kind of look at just straight what was the year-end results in terms of what potentially could be the impact on our true policy reserves, this shows you that it's really a surplus of 179, not a lot of money. And comparing that to the budget is suggests that what did we plan on in terms of using reserves, and that plan, which includes things like carryovers, which complicates things, and other things like that, and some true uses of reserves, that we did better than that on a budget to actual basis. The column in the middle, when I say 179, it's really speaking to what's going to be the bottom line impact to our reserve balances. Another one is just budget to actual comparison. So hopefully that helps.
It does. And the label here, amended budget, does that refer to after the council made whatever amendments we made in the
Yeah.
between last June and this June?
Yeah, so the adopted budget is always balanced. On July 1, that budget is essentially out of balance because we carry over prior encumbrances of close to $1 million every year. It's funded from prior reserves that are accounted for, already spoken for, and earmarked for that purpose. But so the carryover is a big number. And then this year we did have some budgeted use reserves. We did, for example, the big one was in August of 17, I believe, we came to council and budgeted about $1.4 million for additional legal costs and outside attorney costs that we had no choice in doing. We're defending cases, big workload with the city attorney's office, so we funded that from reserves in August of 17, and that was a big use of that. The rest of it is really just the carryovers.
The let's see, what was I going to ask? And the encumbrance figure, the 1,047,000, these are amounts we're committed to paying, but we haven't paid them out yet, either because we don't have the bills or for whatever reason. But these are kind of like account payable figures that
These
just
are
won't get paid before.
executed purchase orders, executed contracts that we have a legal obligation to pay, but they haven't gotten to the point where we recognize them as an expenditure. There'll be expenditures in 19, but because we want to make sure that we truly account for how much money we have available in terms of reserves, spendable reserves, we have to set those aside, and we do that every year.
And this is because it's more of an accrual basis than a cash flow.
Well, it's more.
Because the cash is still in the account.
It's not the difference between cash and accrual. It just means it's a legal obligation. So it's a budgeting device we use to say, okay, how much money do we have to spend? We know we should put aside $1 million, even though we haven't expended that yet or recognized it as an expenditure. We need to set it aside so we're not budgeting the use of those funds.
Okay, thank you.
Sure.
Councilmember Friedman?
I just want to, so I fully understand. So what's, at the end of the day, we have a 2.869 deficit, but then you factor out the Measure C that's going to come from the next year and the encumbrances. So what's the total? Our total estimated kind of deficit?
Yeah, and that's what this is here. So if you measure it in terms of what we believe is going to be the impact to our policy reserves, it's the 179. The other uses of reserves that make up the $2.6 million are amounts that relate to Measure C, which we're going to get back in 19, and then the transfer of surplus reserves that we had in 17 that we didn't get to until 18. So again, that to me is not a policy reserve issue. It's just we had a surplus and we just didn't get to that until 18. So that what's the true bottom line impact to our policy reserves is the 179, which is a slight increase. Doesn't mean that we're not fully funded because we have to recognize our reserve requirements go up.
And what about for the full general fund?
That's the full-
That's the 179 is.
Yeah, I know, it's amazing.
I just want to be. That's what I
$130
thought. I was
million,
trying to understand.
we ended up with the 179 surplus.
Okay, thank you for clarifying that.
Sure. Hey, we'll turn it over to Enterprise, Jennifer, for enterprise funds, if we're okay.
Thank you, Mr. Samario. Ms. Tomaszewski?
Okay, so the next two slides, we're going to be looking at some of the all of the enterprise funds. This first slide, we have solid waste, water, wastewater, and downtown parking. I'm just going to touch on some of the larger variances. So with solid waste, we see that revenues ended the year about 1.5 million, with a 1.5 million deficit, and the cause for this was the decrease in the approved budget, the budgeted rates. The rate increase for fiscal year 18 from 5.3% to 2.1%. And the reason that this decision was made was to remove the impacts of the tipping fees from the delays in the Tahigas Resource Recovery Project. And with that, we see about a 1.5 million deficit that basically we have to fund from the solid waste reserves.
Real quick, let me jump in. So this decision was made in June. The budget was already kind of wrapped up. So the budget assumed that we would, pass on the full tipping fee increases to the ratepayers, and decision was made in June. We didn't amend the budget, so the revenues reflected a rate increase of 5% but that's not what we actually implemented.
And then on the expense side, we see that we have about a $1.2 million savings. This is a little bit deceiving in that about $1 million of this is going to be carried forward into fiscal year 19. It's a timing difference for delays in 2 invoices that we didn't receive until too late to post in fiscal year 18. So those are for the hazardous waste program. So those will be carried over and spent. On the water fund, we see a surplus of about $5.4 million, and this is consistent with how we've presented these in mid-year and third quarter. We've seen that the increase continuing with the water sales. What we're seeing is that the sales are coming in at the higher cost tiers than what was budgeted using the rate model to develop the budget. And then in addition to that, customers are using more water. Also included in this is a little less than $1 million for reimbursements from COMB and CCRB. These are one-time reimbursements for prior year water operating costs. On the expenditure side, we see a savings of about $11.6 million. There's several factors going on here. I'm going to touch on some of the highlights. So as part of this, over $3 million of this relates to the operation of the desalination plant. Of that $3 million, approximately $1.5 to $2 million will be paid to IDE, which is the contractor that operates the plant. And again, that's a timing issue. There's some discussions going on between staff and IDE as to the amounts. So I think they're trying to determine that at this point. Also, whoops, I'm sorry, got a little trigger happy there. Also included in that is about $2 million of debt service with the delays in the completion of the plant. The first debt service payment was shifted from fiscal year 18 to fiscal year 19. And then also included in this is about $1.6 million in savings for water purchases, which are also coming in below estimates, and about $1 million in salary savings. The rest is spread among several line items within the services and supplies budget, and some of those will be also carried forward into fiscal year 19. That's it for the water fund. Next, I wanted to touch on wastewater. Wastewater ended the year about $2.1 million below budget. Some of this is salary savings. Much of these are also spread among various line items and will carry over into 19 as well. So that's it for this slide. Did you have a question before I move
Councilmember
on.
Dominguez.
I'm sorry, the hazardous waste charge under solid waste, what was the approximate amount?
I believe it's about 900,000, give or take.
Okay, thank you.
Oh, and I did also want to point out, I apologize, on the wastewater. We do see a big shift, about a little less than or a little over 4 million compared to last year. This is not related to operations. This is solely capital. And capital is project-based, and that can fluctuate significantly from year to year. So on this last slide, we see airport, Gulf Fund, and waterfront. And I'm going to quickly skip over airport and point out waterfront as well, because the two have similar stories. So both of these have savings, about $500,000 or so from salaries. And the rest, what we've seen is some project delays, some maintenance projects that were turned over to capital projects, and then the rest spread across services and supplies. So I didn't want to have to say that twice, but it's the same story for both of those. And that's it for the enterprise funds. And unless you have any questions, I'll go on to the budget adjustments. And I am going to skip over some of these. I've put slides of all of them up, but I'm only going to touch on some of the highlights. So this is just some true up for year end that we have a lot of, in fourth quarter, we do a lot of truing up against budget between funds. We do corrections, some small grant awards, and that's what you're seeing here. On this next slide, I did want to highlight for fire. So as we talked about in the general fund revenues and expenditures, where revenues were over budget by about $3 million and the expenditures were up as well. This budget adjustment is a request to increase the revenues and appropriations for those mutual aid activities, and also increase for some of the minimum staffing and vacation payouts as well. And that's it on this slide. These, again, are some small grant awards and some cleanup for some completed projects. And this next slide is some small grant awards. And on this next slide, I did want to point out these two. So this first budget adjustment relates to Water Operating Fund and the Water SRF loan. And as you may recall, staff amended the SRF loan and requested amendments for that contract to increase it and to account for additional costs that were being incurred. And as a temporary cash flow, the Water Operating Fund transferred about $12 million. It was two separate transfers, but this is the total of those. And now that those amendments have been approved and awarded, this is just to transfer that cash back. This middle section is similar. We've brought a couple of these to your committee in the past. Before, at the early stages of the desalination project, before we created the SRF loan fund, there were costs that were incurred in the drought fund, some in the operating fund, and some in the capital fund. However, when the receipts of the reimbursements were received, they were brought into the SRF loan fund. Staff's been working really hard to reconcile all that, and in doing so, we found another $1.1 million that needed to be aligned to where those costs were incurred. So that's what you're seeing here. It's a cleanup item. It's just a rather large one. So this next adjustment, this is for the Gulf Operating Fund and the Gulf Capital Fund. In this case, there were two projects that had budget savings, and staff determined the best use of that would be to pay down the general fund loan to save on future interest payments to help strengthen the cash flows for the Gulf Fund. So that's what you're seeing here. And then this last one, this is true up. It's another cleanup item just to align costs with the waterfront operating fund and the waterfront capital fund for some small projects within the Marina One. And this is just a cleanup item. So that's it for the budget adjustments. And with that, that completes our presentation. And I'd just like to recap that we request that you accept the interim financial statements for fourth quarter and approve the proposed budget adjustments.
Thank you, Ms. Tomaszewski. That was very comprehensive. Any additional questions from committee members? Is there a motion? Councilmember Friedman has moved the staff recommendations. Is there a second? Second. Moved and seconded. Any other questions or comments? All those in favor say aye. Aye. Opposed? None. And abstained? None. The matter is approved, and we are adjourned.
Thank you
very much for your time.